Bitcoin is up almost 10% on the week, while Ethereum is going up as well, going up much harder, up over 17% over the last couple of weeks. It is a nice summer bounce that we're having. Tonight, we're going to unpack it all, find out why the market is moving the way it is, what's happening with Ethereum, what's happening with Bitcoin, and just unpack all of the recent price action. Then we're going to get into the main event for tonight, which is a live demonstration of the two most powerful, most effective strategies in DeFi. That is borrowing against our crypto assets, so we can borrow capital against our Bitcoin, borrow against our ETH, and then we'll deploy that borrowed capital into the second strategy, which is providing liquidity on a decentralized exchange. This is how we're going to convert that borrowed capital into daily cash flow. Lastly, we'll take a look at how do we manage the risk, because there is risk associated with doing this. By the way, quick disclaimer, none of this is financial advice. I'm just sharing the moves that I'm making with my own wallet, my own personal portfolio, sharing that with all of you and trying to provide some educational content along the way. So without any further to do, let's talk about the market. So we have had a pretty nice bounce in the market. We're into the summer months, so the volume kind of dries up during the summer. All the big traders and investors are off in the Hamptons enjoying their summer vacation. So the volume does tend to thin out. The liquidity isn't there. So it's a nice move. It's nice to see these prices pumping over the last week or two, but it might not necessarily last. Another thing you have to consider is that roughly half of the circulating supply of Bitcoin is underwater. So the percent supply in profit is just around 50% at this point. This chart comes from James Check, one of my favorite on-chain Bitcoin analysts. And as you can see, basically about half of Bitcoin holders are underwater on their investment right now. So it's a hard environment for any kind of upward move to have some staying power, but we'll see how that goes along. Now, like I alluded to, Ethereum is up a lot more in this move than Bitcoin is. And part of that is because of this here. Just yesterday, we got the news from Strategy. They sold more than 3,500 Bitcoin to raise some capital for their dividends, for the STRC preferred equity product that they have. That's supposedly just like a money market account that pays a high interest rate. Well, turns out they ended up having to sell some of their Bitcoin just to fund the ongoing dividends for those stretch shares. And meantime, we just got the news yesterday that BitMine, the second largest digital asset treasury company, went ahead and purchased another $74 million worth of Ether. And it's kind of ironic and kind of telling that ETH is getting bought up and Bitcoin is being sold off by these two large digital asset treasury companies. So that's part of the reason. Another thing with Ethereum, and this is a big one for me, I'm a huge believer in the future of finance. Everything is going on chain. All financial assets eventually will be tokenized and on the blockchain, and the vast majority of that financial activity will take place on the Ethereum blockchain. It's not just the Ethereum layer 1 blockchain, it's also all of the layer 2 blockchains that sit on top of the mainnet Ethereum blockchain. It's a large ecosystem, and it's massively winning the game in terms of real world assets being tokenized on chain. This is, speaking of real world assets, this is the news from yesterday as well. JPMorgan now has a tokenized money market account or money market fund on chain on the Ethereum blockchain. And just within the last month, the last 30 days, the assets under management for that tokenized money market fund grew by 250% in a month. So like I always say, finance is moving towards these layer one blockchains. It's already starting to happen. The pace keeps accelerating. This is where we're headed. And right now you have the opportunity to invest in these layer one blockchains, not financial advice, of course, but you have the opportunity to purchase and invest in the plumbing, the infrastructure where the future economy will run on these layer one blockchains. The biggest and the baddest one, Ethereum. So I'm a huge fan of Ethereum. And obviously, recently, Ethereum has been outperforming pretty much everything else, including Bitcoin. The institutional rotation is already starting to happen. Of course, in this community, in our community, on this channel, I was talking about rotating out of Bitcoin and into Ethereum quite a while ago. On the channel just 3 weeks ago, on June 11th, we put out this live stream where I answered the question, is it time to buy? TLDR on that. My evaluation was yes, this is the time to buy. The bottom is either in or it is very, very close. And actually in that video, I was reviewing it a little bit today before the stream. At that time on June 11th, the low was 59,000. And I said, I think the bottom is in or it's very close. If it goes lower, it'll probably bottom out somewhere between 55 and 58,000. What we actually ended up seeing on the Bitcoin low just a week ago was $57,800 thereabouts. This also happened to line up perfectly with the 61.8 golden ratio, Fibonacci ratio retracement. So we had a massive rally coming out of the 2022 bear market low all the way up to the October 6th high. And then we had this massive pullback. It's actually a small pullback or a small bear market compared to previous bear markets where Bitcoin dropped by 75, 80, 85%. This one only dropped by about 55%, and it hit that 61.8% retracement just perfectly just the other day. So I think that was a fantastic buying opportunity. I do still believe that the low is in. I do believe it's possible, certainly possible, that we go a little bit lower. But again, I'll reiterate, for me, Bitcoin isn't going to be going too much lower than maybe 55 up to 58,000. We already hit the 58,000. I really don't think it's going to go lower than 55,000. That's not financial or investment advice. That's just my take on it. The main factor that leads me to that conclusion is all of the constant institutional ETF buy pressure. So it's not just strategy. And as we just found out yesterday, sometimes strategy sells coins rather than buy coins. Over the long run, over the weeks and months, they're going to be a net buyer of Bitcoin, so that there's a constant, almost constant bid under the price of Bitcoin. Ether is the same way. We've got Tom Lee and BitMine just announced the $74 million purchase yesterday. And as well, we have the spot ETFs, and we're starting to finally see some inflows on those Bitcoin and ETH ETFs. So all of that constant buying pressure to me means it can't really go too much lower than where we are right now. So the other thing that I've been looking at is the Ethereum Bitcoin ratio. This is the price of Ethereum in Bitcoin terms. So in other words, if you sold 1 ETH, what fraction of a Bitcoin would you get? Or if you wanted to buy ETH, what fraction of a Bitcoin would you have to spend to get 1 ETH? So this isn't the dollar price. This is the Bitcoin price of Ether. And I said several weeks ago that I'm a buyer here, or I'm a reallocator. So this is the the down move here is indicating a period of time where the price of ETH underperformed Bitcoin. But then again, we saw that 61.8% Fibonacci golden ratio retracement on this. And I called that out as a good time to reallocate. And so it doesn't mean that I bought ETH. It means that I shifted my allocations. So at the moment, my Bitcoin allocation, if you look at my entire portfolio, my Bitcoin is actually less than 20% now. It used to be a lot more. Back here in April of 2025, my treasury was about 91% Bitcoin, but at this time, I thought that the low was in. I didn't time it absolutely perfectly, but I massively reallocated my treasury. I moved out of Bitcoin and into ETH, into Solana, into SWE, etc., because I was betting on the low being in, and all of these altcoins, quality layer one blockchain coins, were going to outperform. And what we saw back then was Bitcoin went up. I think it went up around somewhere between 55 and 60%. It was a nice rally from April into that October 6 high. But while Bitcoin was going up, let's say 60%, ETH was actually going up 250%. So there was massive outperformance. Obviously, it cooled off since then. But what we're doing here is we're hitting that golden ratio, the Fibonacci retracement level, and we're marking out or hitting out a higher low. And so that's just a basic chart technical analysis pattern where you had a nice rally, you get a pullback, you get a correction, and you hit a higher low, and then the primary trend continues. So that's the thesis there, where in the previous 3 or 4 weeks, since mid-May, I've started to reallocate. You can see my positioning here, where I was literally swapping Bitcoin for ETH. And you can see in one of my wallets here, this is about $83,000 worth of ETH at the current price, and a little less than 20,000 in Bitcoin. Pretty much, this is the only Bitcoin that I have in this. Well, this is the only Bitcoin that I have in this wallet, and so it's less than 20%. And so that's what has been shifted and reallocated lately in my portfolio. Now, again, we are in the summer months now. The volume is a lot thinner. There's not as much liquidity. There's not as much activity. So it means you can't really trust these kinds of moves that we've been seeing in the last 2 weeks. You can't trust them. They don't have as much staying power if they're not reinforced by a tremendous amount of volume. And it's just not happening because we're in the summer. So what I want to talk about, one of the things I wanted to mention tonight, is this kind of a summer range thesis. Okay. Now, if I'm not a huge fan of the 4-year halving cycle price action explanation for Bitcoin. I don't think that the price of Bitcoin will follow this 4-year cycle strictly in the future. I think that 4-year cycle has been kind of broken because of government debt. It's really based on the refinancing of government debt, which means printing of liquidity, printing of new dollars. Every time they need to refinance the debt, they don't pay it off from their bank account. They just borrow more to pay off the old debt with new debt. And that's always a process of creating more and more dollars. That is what's been driving the cycle ever since the great financial crisis in 2008. And so the government debt, that refinancing process, the average maturity was 4 years. And so every 4 years, the government basically would have to refinance a crap ton of debt, introduce a bunch of fresh liquidity, and that's what would lead to a rally in Bitcoin every 4 years. Well, after 2022, the government refinanced a bunch of its debt ahead of schedule. because we had just had the pandemic. We had just had crazy stimulus and everything else, and rates were super, super low. So the government was able to stretch that average debt maturity from 4 years out to about 5.5 to 6 years. Okay, so that stretched that refinance process that the Treasury has to go through. Instead of every 4 years, now it's every 5 to 6 years, which means the whole cycle gets stretched out. I don't think it was ever really based on the halving. I think it was based on US government and dollar liquidity, and now that's a longer process. So anyway, I'm getting off into the weeds too much. What I think is going to happen, and again, if the 4 year cycle people are right, and they could be right, this last time, is that people are saying the high was October 6th, and so the low will be exactly 1 year later, give or take a few days. So that would mean that the low won't be until October. Now, again, if we do go lower, my thought and my guess is that it won't go a whole lot lower, maybe down to 55K on Bitcoin. But I think less likely of getting a lower low. I think what's more likely to happen from now until sometime in October or November is just a lot of sideways chop. There's already a very low level of sentiment around Bitcoin and ETH and all of crypto. In many ways, crypto Twitter is more negative now than it was back in, FTX times when Sam Bankman-Fried was out defrauding the crypto universe. And so sentiment is extremely low. We've got this nice little pump in the last 1 or 2 weeks. But my thesis here is that we're just going to be range bound sideways for the next few months. Now, I would be happy to see up and to the right from here on out. Nothing would make me happier. But I have to be realistic in what we can expect. I don't think Clarity has much of a chance of passing anymore. The odds for Clarity passing just keep dropping and dropping. So not that we really need that in the way that we operate in DeFi, but that does set the ground rules for a lot more institutional participation in all of these layer 1 blockchains. So Clarity, if it does pass, that will be a massive what's the word? That will trigger a big rally in crypto. And if Clarity doesn't pass, then we're just going to kind of hang out and go sideways. Technically, I'm a technical analyst on these charts. I do think there's a solid resistance level. We've already seen this on ETH. And the reason I'm going through this, I want to do the market update. I want to analyze this price action. But more importantly, this is going to factor into what's coming later, which is I'm going to open up a liquidity position. And the token I'm going to provide liquidity for is ETH. Okay, it's going to be wrapped ETH USDC in terms of the liquidity position that I'm going to be opening tonight. I'm going to open a position of about $9,400 and show you exactly how to set that up live on stream. So stick around if you want to see these two powerful strategies in DeFi: borrowing against our crypto and providing liquidity on a decentralized exchange. That's where you get the daily cash flow from. So if we back out to, let's back out to a 4-hour chart, we saw the June or the February 5th low right here. And then this low right here, there was a little inverted head and shoulders pattern right here. If I zoom in on this area, you can see the low right here on this day. Let me do a daily chart. So over the course of about a week here, we had the low of day, We went a bit lower, but closed above, big candle here. And then we came back and tested almost that exact level. I mean, it was almost to the penny here on the low on this day. And from this day forward, this was a very long lasting low. Okay. It didn't breach that low again until June 3rd. Okay. On the way down to this June 5th lower low here. And even right there, you can see that low or that level held as a low right there, at least for this day here. It tried to open and continue higher, but then it failed and dropped down. And so now what we've seen recently, pretty much the same level right there, got a little bit higher, but it got rejected from that level. So the level that used to be support was converted, it morphed, and it is now acting as a resistance level. So previously, prices would come down and bounce higher from that level. And nowadays, recent price action, price will come up, hit that level, and get rejected back down. Now, that's nothing in trading, nothing in markets is a sure thing. There's no guarantee. There's never complete certainty when you're dealing with markets. Everything is based on probabilities. And so I am not saying that price will definitely continue lower from this resistance level, but I'm saying the probabilities are there. It's more likely to reject and come down from that level than it is to blast through and go higher than that level. Doesn't mean it can't happen. I just have to go with my probabilities and assess that like that based on the previous price action and where the price has reacted. I'm not a big fan of indicators. When I was doing day trading for more than 10 years, I was strictly what they call a price action trader. And I believed that all of the necessary information to be able to make a judgment about the probabilities of a particular price move, all of the information that I needed to make those decisions was contained in the price itself. You can go down that rabbit hole of price action trading if you want to, but that's what informs me, or that's how I make my decisions with respect to providing liquidity. Because of course, when I provide liquidity, I'm using a concentrated liquidity position. That allows us to be very efficient with our capital. We get to focus our capital into a specific price range, and we provide the liquidity for trading that happens within that range, and we generate fantastic yields when the price is inside that range. So it's very important to designate your range. And the way I figure that out or go with the probabilities is by what you're seeing right here. I look at the chart, I analyze the price action, and I make a determination as to where is the price going to find resistance above and where is it likely to find support below. All right. So, oops, let me stop that. So that is my thesis for the summer months. I think that Ethereum is going to be range bound. I think it's going to chop sideways. And what's awesome about that, my spot assets won't be going anywhere. You know, the coins that I have in my wallet, the coins that I've posted as collateral on Aave, if the price isn't going anywhere, I'm not making money, I'm not losing money. That range-bound price action, it's terribly boring for your spot assets. On the other hand, for a liquidity provider, it's an ideal environment. It's a dream come true if you can get that price to just chop sideways, stay inside your range, you know, and capture all of that price action, or the vast majority of that price action inside of your range. It means you get to collect those trade fees the entire time. and you don't suffer any real impermanent loss. Maybe if it drops down, you know, you're in a loss situation there when the price goes down to the bottom of your range. All of the ETH in your position is going down in value. The value of your position is dropping. But if it's range bound, it's going to revert to the mean. It'll bounce back up and the impermanent loss goes away. And all of the fees that you collect during that time make up for any impermanent loss that you have. And again, the permanent loss can be overcome in two ways. One is you just collect a ton of fees. And so maybe you lost a little bit if the price went down, but if it took a long time for it to go down, you've collected so many fees during that time, you more than make up for the loss with the fees. And the other way is if the price just rebounds, right? So if I put my range somewhere like so, right? If the price drops from here all the way down to the bottom of my range, I'm in the red. My position has lost value. Of course it has, because the ETH that I bought to load into the position, plus all the other ETH that I bought as the price moved down in my range, right? All of that has dropped in value. So the overall dollar value of my liquidity position is going to drop. But if it then goes down to the bottom and then bounces back up, it just comes all back. So all the ETH that I bought down here with my position, that gets sold at the same price on the way back up. If the price returns, the impermanent loss is gone. That's why it's called impermanent. It's not set in stone. It's not a realized loss. It's a temporary loss, potentially. All right. It can become a realized loss if the price escapes your range and never comes back. Then that loss is locked in if it never comes back. But it's impermanent if the price goes down and then it comes back. Okay, so we can unpack more about impermanent loss if you like. By the way, I should have mentioned this a long time ago, but I appreciate you live viewers right now. Looks like there are about a dozen of you tuned in, so thanks for being here live. If you have any questions about anything that I've said or anything that I'm going to say or any of the demonstration that I'm going to go through, please do not hesitate to interrupt me and ask your question. Okay, that's the point here. I do this live stream every Tuesday night, and lately I'm not seeing any questions. I don't know what that means. Probably there's not a lot of people out there that are even interested in crypto in the first place. It's such a bad sentiment right now. Plus, you know, there's probably not a lot of people that are actually working these strategies. So let's get into it, because again, these are the two most powerful and most effective strategies that DeFi has to offer. So the first one we're going to talk about is borrowing against our crypto. So if you have Bitcoin and or ETH or Solana or SWI, whatever you have, well, whatever blue chip coins that you have, crypto assets, for the most part, you can provide those coins as collateral and borrow against. Now, I'm not going to go through all of the steps one by one in this process, but if you need a more focused, detailed, nitty-gritty tutorial, I would recommend watching this video right here. How to borrow money at 4% interest. So I'm just going to go through this relatively quickly, and I'm going to do the transaction that I want to do without explaining a whole bunch. And if you need more details, like I said, you can watch that video. So here's my collateral position on Aave, and about $103,000 worth of mostly ETH and a little Bitcoin. This is Coinbase wrapped Bitcoin, which is a tokenized form of Bitcoin. And this is just a little bit of wrap staked ETH. just some scraps there. So mainly it's ETH and Bitcoin as my collateral, and I've already borrowed some capital against this collateral. Notice that the interest rate, this is a variable rate. It adjusts over time based on supply and demand. At the moment, 4.2% to borrow USDC. This is a stable coin. It's pegged to the dollar. You can send it to your Coinbase account and convert it instantly. 1 token per $1. No fee, no slippage, none of that, no price difference. It's 1 for 1 for the dollar, especially on Coinbase, where you don't even have to pay a trade fee for USDC. So the interest rate is there about 4.2%. Notice the interest rate to borrow ETH is much lower. So less than 2% per year to borrow this money. Now, I'm going to borrow a combination. And what I want to do is I want to open up a new liquidity position, and I want about $9,400. That was the last position that I closed out. And so what I want to do is I'm going to start out by looking at my base account here, and I already have about $2,900 of USDC and about $140 of wrapped ETH. So I've got a little over $3,000 already. I need to borrow another roughly $6,400 to fill out that target. I want to deploy $9,400. So I'm going to start out by looking at our app. And we have the portfolio tracker app, which is part of, signing up with Overseas DeFi, whether you're in the accelerator program or just in the community, you get full access to this app, and it connects with your wallets. You can have up to 3 different wallets on the EVM blockchains like Ethereum, Base, Arbitrum, even BNB, or the Sui blockchain. And pretty soon we're actually going to have Solana on this as well. So you can connect your wallets, and the portfolio tracker can see all of your different crypto and DeFi positions. Now, what I'm going to focus in on is the lend borrow tracker here. And I'm going to specifically look at my Aave position on base. So here it is. This matches up exactly with what I have over here on Aave. You can see the ETH, the Coinbase wrapped Bitcoin, and there are my current borrows there. My loan to value ratio is a little bit less than 62%. Excuse me. And the tracker here also calculates your maximum drop. So if the price dropped 29% from the current levels, then this position would face liquidation. So the way I like to determine my situation here is with our liquidation test. This is a simulator where you can borrow additional assets, and then you can input different price scenarios and kind of see what your LTV would be and where you would be liquidated. Now, most of my collateral is in ETH, so it's showing the price of ETH right here, but it also shows the current price of Bitcoin right here, and as well as the loans over here, my ETH borrowed over here, and the current price and the USDC, etc. So I want to borrow about $6,400. And the way I'm going to do this is I'm going to borrow mostly ETH. And I'll explain why I'm borrowing mostly ETH as opposed to borrowing all USDC or mostly USDC. And it has to do with where the market is and where it's most likely to go from here, which is down. We talked about that already. The price right now is closer to this resistance level than it is down here, where there's clearly a support level. Look at all those daily candles, and the bodies line up almost perfectly at the lows right there, or at the open or closing price. The bodies line up very nicely right around 1570. Okay, so that's actually probably going to be where I put the bottom of my range. Very clear. I mean, even over there, look at that body, that one, more or less. All of these bodies line up with each other very closely, right at that 1,565 to 70 level. Okay, so the price is relatively high compared to down here. So the probabilities, if I'm right, if this is just range bound for months, it's probably going to come down here. So I'd rather borrow ETH when the price is high, and then I can reallocate that debt or swap that debt when the price is low and go the other way. I'll explain how this works. And I'm going to use our portfolio tracker app to demonstrate this. So the first step, I'm going to figure out if I borrow this capital on Aave, what's my LTV going to be? And as a result of borrowing that capital, where's my new liquidation price? You can see at the moment, my liquidation price is around 1,282. I really don't think ETH is going to go that low, but that's where I would be liquidated if it did. And if I borrow more, my liquidation price is going to go up. But the way I'm going to do this, let's click on the borrow button. I'm going to borrow 3 ETH. Okay, so ETH is trading for about $1,800. And so 3 ETH would be $3,600. Is that right? 3. Can't talk and do math at the same time. So let's just see about that. $5,400. Excuse me. I was way off. So $5,400. So I want to borrow about $6,400. I'm going to borrow $5,400 worth of ETH and 1,000 worth of USDC. So let's simulate this. Let me change this to 1 so it'll go a little bit faster. And watch my debt here. This is the current debt amount. You can always reset it after I mess around. But I'm currently borrowing 7 coins on the ETH side. If I borrow 8, 9, 10, that would be borrowing 3 additional ETH compared to what I already have borrowed. And you saw the LTV slider here adjusted higher. So that would put my loan to value quite a bit higher. And then I said I also am going to borrow 1,000 USDC. So let's add that. My current USDC debt is about 52,000. So we pump that up to 53,000. Now my LTV, after I do that additional borrowing, my LTV is going to be almost 68%. Now my liquidation price is going to be closer. So let's see where we'll use the price scenario here. I'm just going to click on this minus button, and you can see the price of ETH dropping. And we just talked about that support level at 1,570, thereabouts. If it drops down there, I'm still safe. I'm not getting liquidated. And then if it drops even more, eventually the LTV is going to hit the liquidation threshold. And this is what you need to be aware of. Now, I have a plan, and we can talk about what my plan is a little bit later, but I don't anticipate ETH dropping this much. But if it does happen, I will have a risk mitigation plan that I can give you some more details on that in a little bit. But first of all, let's see where my actual line in the sand would be. Okay, so just over $1,400 on ETH and just under $50,000 on Bitcoin. compared to where the price is right now, I feel very comfortable with this, but this is definitely a personal decision for you as an investor. You need to figure out for yourself what your risk tolerance is. What I really like about this, though, is this allows me to fine tune it and then simulate the price move and figure out, okay, what is my line in the sand? And by the way, that number, your desired line in the sand, that is also something that you need to determine for yourself and live with the consequences if you're wrong. Like if I do this and the price drops to under $49,000 for Bitcoin and under $1,400 for ETH, I'm cooked, right? So this is the risk that I'm taking. I'm prepared to take. But if price just tanks in 20 minutes, I'm going to get liquidated. I really don't think that's likely, but it could happen. So this is a personal risk decision. Obviously, none of this is financial advice. What I can do is teach you how this works, teach you to use this tool. You can sign up for Overseas DeFi, the community, $97 a month. Learn how to do all of this, get the portfolio tracker. The AI bot in here is completely trained on all of our strategies, all of our workshops, all of our open office hours calls, basically every word I've ever uttered about DeFi and Roman as well is all built into this AI chatbot. So it's completely well-trained on DeFi and it's connected to the app. So it can see your wallets. It can see all of your portfolio, all of your different positions, and it can guide you through different moves that you can do with your portfolio, how to do it, what the risk is, et cetera, in real time, 3 o'clock in the morning, if Roman or myself, we're not available to answer your questions live, or if we're not on a live stream and things like that. So anyway, it's very nice, in my opinion, to be able to simulate all of this and figure out my line in the sand. So that's what I'm going to go ahead and do. I'm going to borrow 3 ETH and 1,000 USDC in addition to what I've already borrowed. And then we'll deploy that capital into a liquidity position. So watch how easy this is. I need to unlock my ledger. I use a ledger hardware wallet to secure my master key. My seed phrase is locked inside this secure digital container. Safest way to operate in self-custody, crypto, and DeFi, in my opinion. So watch this. So I'm going to borrow USDC. I just click the button, type in the amount, acknowledge the risk. And here we go. Sign the transaction. So this pops up on my Ledger hardware wallet, and I have to press the buttons physically on the device to sign the transaction. Boom. So there we go. We've got the extra 1,000 USDC. Now I'm going to borrow some ETH. I'm going to borrow the wrapped ETH token rather than the coin version. So I'll click this toggle here. That's just going to make it easier when I'm ready to load this capital into the liquidity position. It needs to be wrapped ETH. So what did I say? 3 coins here. Acknowledge the risk. Click the button. And sign the transaction. Now, when you borrow money in DeFi, obviously there aren't any forms to fill out. There's no credit check. There's no banker's hours or anything like that. And the money instantly comes out to your wallet. So that money is now in my wallet in addition to the USDC and the wrapped ETH that I already had. My wallet app, my Rabby wallet here, sometimes it's a little bit slow on the update here. Let me just click that button here and we'll take a look at the portfolio on base. And yeah, there it is. So now I have 38, almost 3,900 USDC, about 50, almost 5,500 of wrapped ETH. So together that is 9,360 or so. Close enough. All right, I said I wanted to deploy about $9,400. Looks like the price of ETH is down a little bit from that 1,800. Anyway, close enough. Now, that's the borrowing. So I already posted the collateral. Once you have that collateral posted or supplied on Aave, you can borrow against it. Of course, there's risk. You're trusting the code. It's a smart contract. It's actually a collection of smart contracts. Aave has been in this business the longest, longer than any other decentralized lending and borrowing protocol. It's the oldest one. It's the most audited, most battle-tested protocol there is in DeFi. Doesn't mean it's impenetrable, but it hasn't been hacked. It hasn't been exploited. And so Aave is the protocol that I trust the most, and this is the main one that I use. The other risk is what we already talked about, being liquidated. If my collateral prices crash, my loan to value ratio grows. If it hits that liquidation threshold, like we talked about on the little simulator there, the protocol will automatically sell some of my collateral to pay back some of the loan. It won't sell my entire position, but I will definitely get some of my coins forcibly sold in order to pay off a portion of the debt and get my loan to value ratio back under control. So just be aware of the risks and understand what you're signing up for when you do borrow against your collateral. This is an over-collateralized lending and borrowing position, and it needs to remain significantly over-collateralized, meaning the value of your collateral needs to stay significantly higher than the value of your loan. Now, let's talk about why I borrowed more ETH than USDC. And I said already it's because the price is relatively high. Doesn't mean it can't go higher. It just means that the probabilities right now is that it will go lower. It's more likely to go lower than it is to go higher. So let's take a look. And sometimes our app doesn't instantly update, but let's see if we refresh the tab here, refresh the app. It is connected to the blockchain, of course. My wallet address is in there, loaded in. So let's see if the app has updated that position. The real position here is I've now borrowed 10.02 ETH. So on the app, give it a second here to update. Again, guys, if you have any questions about this, I understand this is fairly complicated stuff. So if anything is confusing, or if you've tried any of this and you've had some issues, just let me know. It does look like it's updated. Yep. So there's the new borrowed amount of ETH and the new borrowed amount of USDC. And so there's my new liquidation price, about 1,409 on ETH and 50,370 on Bitcoin. Now, I'm not saying that ETH and Bitcoin can't go down to these prices, but I think they probably won't. And I think that if they do, I'll have enough time to be able to mitigate that risk. Now, the money came out to my wallet. So one thing I could do is just pay it back. And I'm going to deploy that borrowed money into a liquidity position, and that value could drop, but it's not going to go to zero. Even if the price starts crashing and we go back down to 1500 on ETH, like I'll have less than the $9,300, but I'll still have a good amount of that, and I would be able to either add that to my collateral or pay down some of this loan. But what I wanted to talk about again is, why did I borrow more ETH than USDC? That's because of this right here. If the price does start to drop, I want you to focus on the dollar value of my debt. With the prices where they are right now, the dollar value of my debt is about $70.8 thousand. If the price starts dropping, watch how that number decreases. The value of my USDC loan is unchanged because it's a stable coin. It doesn't change as the price drops. But the dollar value of this 10 ETH does drop. And Aave doesn't care about how much it would cost me to buy 10 ETH. What it cares about is that I have to pay back this loan in ETH. See, I don't pay this loan back with dollars. I pay it back with ETH. So worst case scenario, price drops, my liquidity position gets converted to ETH, and I just pay that ETH back over here. That would wipe out that loan, and it would actually cost me less in dollar terms. So notice the dollar value of the loan is dropping considerably. And so by borrowing ETH when price is high, if the ETH drops in price, the dollar value of my debt obligation is shrinking. That's a good thing. So this is actually what we call a synthetic short position. A short position is a position that benefits when the price drops. Most positions, like spot assets, if you buy stocks or whatever, most positions benefit when the price rises. A short position benefits when the price drops. So this 10 ETH is a short. It's a position. It's a little chunk of my portfolio that benefits as the price drops, which is one of the ways, this is one of the ways I'm mitigating the risk of what I'm about to do next, which is to provide that $9,400 as a new liquidity position. I've talked already long enough about this. There are other videos on the channel where you can dive more deeply on hedging and shorting. This video right here is really good for understanding how to hedge a liquidity position right here. This delta neutral impermanent loss doesn't have to destroy your yields video right here. So if you want to dive more deeply on that subject, definitely recommend watching that video right there. What I want to do next, now that I've borrowed the capital, see, this is the beautiful thing. I've borrowed this capital. I'm paying less than 4% on this loan, right? So some of it was USDC, on which I'm paying 4.2%, but most of it was ETH that I borrowed, and I'm only paying 1.87% interest on that. So I'm paying something around maybe 3.5% interest on the borrowed capital. That's my carrying cost. So I'm paying interest to borrow this money, but I'm going to take this borrowed money and deploy it into a liquidity position that is most likely going to earn something on the order of 60 or 70 or 80% APR. So borrow at 4%, earn at 60%, 70%, 80%. I'm running out of time, but I wanted to quickly, I'm going to be creating a video talking about that carry trade, that borrow low, earn high strategy. But one of the things you can look at quickly here is if you look at this position here from June 25th to July 3rd, just pause the video and add up all those fees. And then there was this position here, I think it is. Yeah, these were actually two contiguous positions where I opened it on June 9th with about $9,300, collected all these fees. And again, you could pause the video. Then I rebalanced the position. I moved the range. That's why this number here and the timestamp, June 25th, 1140. If you look at that, the beginning of this, June 25th, 1140, it's the same position. I just moved the range. So if you look at the capital deployed and you add up all the fees that I collected, and this is real data. I could click on any one of these fee collections. You can see the blockchain record here on base scan. So all of these fees that were collected over the course of about 24 days, it was about $471 that I collected off of $9,376 that was invested or deployed into the liquidity position. You add all that and do the math, it's a little bit better than 6% per month. Okay, so about 76% APR. Again, don't take my word for it. You just saw all the numbers. 9,376 put into the position, all the fees, and then I moved the range, collected more fees, then withdraw, and you can do the math on that. About 76% APR. The ranges on this were actually pretty wide, a lot wider than I normally use for my liquidity positions, which actually is why the yield was so low. In my world, 76% annual yield is just kind of so-so. A lot of liquidity positions put off a lot more yield than that. I've had positions that yield more than 250% annual yield. Okay, it all just varies on what tokens and how narrow your range is and things like that. But anyway, that's the power here. And this is only really available in DeFi with the lending and borrowing and the decentralized exchange, the decentralized liquidity pool that I'm about to demonstrate finally after an hour. You can probably tell I do enjoy talking about all of this stuff. I'm a teacher at heart. I have been teaching technology for almost 30 years now, which is sad to admit that I'm that old, but it is what it is. Okay, so to do the liquidity position, first of all, there are a lot of different wrapped ETH USDC liquidity pools out there, different blockchains, different exchanges, etc. I'm going to focus in on the most trusted, original, decentralized exchange. Literally, Uniswap is the one that invented the decentralized exchange and the liquidity pool and the automated market maker smart contract and everything else. So I'm going to go with Uniswap v3, and we've already decided that I'm going to do this on the base blockchain. The reason for that is this right here. So Crystal is a website that evaluates these different liquidity pools. And it's kind of like comparing apples to apples. So you have different pools here. There's different fee tiers. There's different volumes, daily volumes. There's different TVL, which is how much money is sitting in the liquidity pool, which for us means how many other people do I have to share these swap fees with? But the nature of the beast here is that when you provide liquidity, you're putting your tokens into the pool. Other people are going to trade these tokens. So other people are going to swap ETH for USDC. Other people are going to swap USDC for ETH. And every time other people trade, they pay a fee. And the liquidity providers like us, we're the ones that receive those fees. So we get compensated by real on-chain swaps, real trading activity that happens 24/7, 365. So it's a very sustainable business model. This is real volume on-chain taking place every day, and we're simply collecting a fee as liquidity providers, providing liquidity for all of these other people to trade in and out of. Okay, so I'm going to provide WETH USDC, which is wrapped ETH USDC, and the different fee tiers and TVL. Like I said, we have to share the fees with all the other liquidity providers as well. So the TVL actually hurts us in the sense that more TVL means more sharing is taking place. Your slice of the pie is smaller. But Crystal looks at all three of those. It looks at the fee tier. It looks at the volume. It looks at the TVL. And then it calculates the yield earned by that liquidity pool, in this case, over the course of 7 days. So this is looking at 7 days of volume in the past, comparing all the yields that these different pools earn. And then I simply sorted it. And the top performing pool, according to the last 7 days of trading volume, was this one right here on base, the 0.3% fee tier. I can also look at the 30-day. And again, this is looking at all of the volume over the last 30 days, which pool provided the best yield. And once again, it's that 0.3% fee tier. So sometimes Crystal does this. I was hoping I'd be able to use the little simulator to figure out my balance. Let's see if I can't get it to refresh. While we're waiting for that, I'm going to go back to the chart. We've already kind of decided I'd like the top of my resistance, and I want the bottom of my range to be down here around 1570. So 1570 up to 1836. That looks like it'll work out pretty well. And what's going to happen when I provide liquidity, traders are going to trade, and it's my tokens that they're trading. So what that means is if traders are buying ETH, the price goes up, right? If most traders are buying ETH, the price is going to go up. If traders are buying ETH, it's my liquidity position that is selling the ETH to the traders. So the traders pay me USDC, I give them some ETH. So if the price goes up, what's happening from my perspective is I'm selling ETH all the way up. So what that means is when I deposit my tokens into this position, I need to deposit ETH up here, right? Because if the price starts going up from where it is currently, that part of the position needs to have ETH that's going to be sold to the traders all the way up. And the bottom of the position needs to be USDC. So if traders start selling, the price goes down. If traders are selling ETH, guess what my liquidity position is doing? It's buying ETH from the traders, meaning it's sending USDC. So I need to load USDC down here and load ETH up here. So if you just eyeball that, it looks like to me it's going to be about maybe 22% ETH and 78% USDC. It's hard to talk and live stream and do math at the same time. So I would eyeball that and say it's going to be about 22% wrapped ETH and 78% USDC. So in a moment, let me just delete these extra things. Here, I'll just do it this way. This is easier. Delete, 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 delete. Okay, this is gonna work better. So the top of my range, I want it to be about 1837 and 1569. 1837, 1569, and I want to load, let's say 9300. I have a little bit less than 9400, so we'll go ahead and just make 9300. So that means I will need approximately, I was not too far off on my numbers. That's 21.6% wrapped ETH, 78.4% USDC. Or in other words, I need about 7290 USDC and 1.13 wrapped ETH. What do I have right now? I think I have too much wrapped ETH. So in actuality, I need to sell some of this wrapped ETH. Let's take a look. Uh, 3.08. And I only need 1.13. So I'm going to sell 1.95 of my wrapped ETH. So let's go to 1 inch. Oops, let me show you the cool way, the best way to find a DeFi website. Never do a Google search. Guys, if you search on Google for a particular crypto or DeFi website, chances are you're going to get led to a scam website. So you don't want that to happen. What I like to do, build hobby, is this DApp search. So click on that settings wheel right there, click on search dApps, and then search for the exchange or the app, whatever app you're looking for. There's Hyperliquid, by the way. 1 inch is the DEX aggregator I'm going to use. So there's the official website. So just pop that up. Connect my wallet. Oh, it's already connected. So let's do a swap. And I've been trading some Venice tokens lately. So I'm going to sell 1.95 of my wrapped Ether. And that's going to give me some USDC. So let's go ahead. So this is the token approval, allowing the smart contract to take wrapped ETH tokens out of my wallet. I don't need the unlimited approval. I'm just going to click on that and set the approval to my wallet balance. Sign the transaction. So that token approval, again, it's like a permission slip. You're giving permission to the smart contract to spend those tokens out of your wallet. Those are your tokens, so you have to sign a permission slip before the smart contract can take those out of your wallet. There we go. So now that went through and I can actually do the swap. So I'm going to pay 1.95 wrapped ETH and receive that amount of USDC. So let's go for it. It's difficult to get through all of this content and keep it within a 1 hour live stream. I'm already at an hour and 10 minutes. So definitely unsuccessful on that. There was a lot more that I wanted to get into, but at least we'll finish out creating the liquidity position. And we got a lot done. We talked about the market. We analyzed the price action. We looked at the bounces. We looked at the fundamentals. BitMine buying more ETH. Meanwhile, strategy is selling Bitcoin. Tokenization keeps on chugging along, experiencing massive growth. And JPMorgan's tokenized money market fund. It's really good news fundamentally for these assets and these layer one blockchain coins. And then we did the lending and the borrowing, which is a huge benefit. We talked about borrowing at a low interest rate, and now we're deploying that borrowed capital into a liquidity position where it's going to earn a heck of a lot more than 3 or 4%, which is what we're paying over on Aave to borrow that capital. So literally, you're spending $25 to make $400. That's how it works out on that 24-day position I talked to you about, the previous position in June and July. I made $471 in fees, and I did it with $9,300 of borrowed capital, on which I paid about $25 in interest. So I paid $25 in interest to borrow the money, but then I earned $471 in fees. And that was just 24 days. That's why the thumbnail says, whatever it says, $589. That would be the monthly rate at that six or so percent per month, which is what I actually earned on this legitimate on-chain liquidity position. Again, I said the ranges on those positions were pretty wide, a lot wider than I normally run. This range is going to be pretty wide as well. But now that we have the capital and it's properly balanced, let's take a look again at the Aave wallet and the portfolio and the tokens that I have in here. Again, just clicking on the base assets here so we can see those. So now I have the 7,359 USDC and just the that's perfect, 1.1312 wrapped ETH, I think, is exactly what we needed on this. Well, it changed a little bit because the price moved around, actually moved a little bit higher. So let's go ahead and make this deposit and see how she goes. So I'm going to do this on Uniswap. Like I said, I already have a liquidity position here in Venice tokens. I'm going to open a new one. It's going to be a V3 position. And my two tokens are going to be on the base blockchain. So there's a little almost hidden drop-down menu right here where you can choose the network. This is going to be on base. And I'm going to use the wrapped Ether token as well as the USDC token. Now it's already selected that 0.3% fee tier. That was the top performing pool when we analyzed it over on Crystal. Let's continue. The range is going to end up being 1568 up to 1833. $18.33. Perfect. Now I could go a little bit higher. I did want the top of my range to be, well, no, that's close enough. 1837 would be the exact level. These liquidity pools, they won't let you fine tune this down to the penny or even the dollar. If I go one tick higher, it's going to be all the way up at 1844. So 1833, like it's actually pretty much right where it topped just yesterday. If you look at the high of that candle was 1831 62. So I'm going to go with that and go ahead and make the deposit. Now, I have the USDC. My wallet is connected, so we can see the balance of my wallet. There's that wrapped ETH. There's my USDC. Let's try something. Let's say if I maximize the USDC, that's going to work perfect. It's going to match that USDC with 1.12 wrapped ETH, and that's less than what I actually have in my wallet. So that's going to work perfectly. If I did it the other way, if I tried to shove and deposit all of that wrapped ETH in there, notice it requires more USDC to go with that ETH. So the protocol automatically does the balancing based on the top of my range, the bottom of my range, and wherever that price currently is right now. So it's going to be a moving target. The price is going to bump around, and you'll actually see these numbers change. And the protocol is going to force that deposit to fit. So if I tried to put all of the wrapped ETH in there, I don't have enough USDC, right? So instead of putting all the wrapped ETH in there, I'm just going to put all of the USDC in there, and then I'm going to have enough wrapped ETH to make this deposit. Just quickly doing the math there, it looks like it's 93.50. So that's perfect. I wanted to deposit somewhere around 9,400 bucks. So close enough. You're never going to be able to get this thing perfect. You just have to let go of those OCD tendencies. If you're like me and you suffer from OCD a little bit, hey, I think I recognize you from some of your comments on the channel. So awesome. Found you last week and I'm making ample fees. Wonderful. Let us know, what have you done the math, and what is your annual yield? If you've been able to do the math and kind of figure that out. You just started last week, so you don't have a ton of data, but I'd be curious if you've done the math and kind of try to calculate your yield. So, oops, I'm going to reject that transaction because I just noticed that I had the wrong token approval. I was about to sign an unlimited approval, and that is a no. That's not extremely dangerous, but it's more dangerous than it needs to be to give that unlimited permission slip. Yeah, you got it. It's my pleasure. As you can tell, I love talking about this stuff. I love teaching this stuff. It just completely floats my boat to do all this stuff online. So thank you for being here. I appreciate you guys showing up for the live stream. So I'm going to reset that token approval to my wallet balance and sign that. So again, this Uniswap protocol, just like 1inch, it needs permission. You have to sign those token approvals to give the smart contract permission to take tokens out of your wallet. That's a safety feature of DeFi. Now, for some reason, this popped up on my other screen, so I'll drag it back over here. I approved the wrapped ETH. I need to also approve the USDC token. So again, I'll set it to my current wallet balance. No need for unlimited approvals over here. And the third and final transaction is the deposit itself. Now, I want to call out some details here. First of all, you can see the USDC will be leaving my wallet as well as the wrapped ETH. Again, it looks like it's going to be about $9,350, maybe a little bit more now. And this right here is an NFT, right? So NFTs are useful for more than just, you know, images of cats and crypto punks or whatever, right? These NFTs actually have a real utility. And this NFT is a Uniswap NFT, and it represents ownership. So this is my proof of ownership for this liquidity position. This liquidity position is at the moment worth about $9,300. So this NFT represents, represents my ownership, and that NFT gets minted by the smart contract and it comes to my wallet. That's why there's the green +1 here. I'm receiving that NFT. So let's go ahead and open the position. And it's in. Created position. And now up on my dashboard here, there's the position I already had, and there's the new position right about $9,350. Now, this APR here, just take this with a grain of salt. You can't necessarily rely on this yield. This is estimating your annual yield based on the data right now. So what is the volume right now? How many people are swapping ETH and USDC? And what are the fees being generated? And how much TVL is in the pool where you're sharing the fees with everybody else? All of that data, this is like a snapshot. As of right now, I'm earning 83.6% yield on this position. Doesn't mean it's going to stay that way for the whole year. It's probably not even going to stay that same for the next 10 minutes. The volume might increase, it might drop down, more people might enter the pool, maybe people will remove liquidity from the pool. It's a moving target. And so what I like to do, and the final piece that I just want to show you tonight, is our new fee tracker. So we already have the full portfolio tracker. We've had this for a couple of months now, and it connects to your wallets, and it can see all of your positions, your spot assets, your lending and borrowing positions, even perps. So if you're a fan of trading perpetual futures in crypto, I actually have a long position open right now on GMX. It shows you the fact, everything about the position there. So all of that is included in our portfolio tracker. And just a couple weeks ago, we introduced this brand new feature called the fee tracker. And so I'm a spreadsheet guy. I've been tracking all of my liquidity positions and all the math and calculating the yields and keeping track of the dates and the times and the fees and the deposits and everything I've been tracking in a spreadsheet. And so then over the last few months, I've been building this fee tracker app, and we've included it in the Overseas DeFi portfolio tracker. Again, if you sign up for Overseas DeFi, regardless of the level you come in at, you receive this this app as part of your membership. Okay, so everybody gets this when you come into Overseas DeFi. It's very handy, and what I really like about it is this replaces my spreadsheet. And you can see this is amazing because it has already updated. I just opened that liquidity position. So here's the new position, and the only event so far is my deposit. Now the numbers aren't going to be exactly the same. Maybe Uniswap says $9,348, and this one says $9,343 a night, whatever. But it's going to be roughly the same numbers. It's just where it gets its pricing data. You could even look at the details, and you can see I deposited the USDC there and the wrapped ETH right there. And the price at that moment was 1774.48. So all of those details are in there, but what I really like about it is the fee tracking. So let me show you this older position. I'm going to resort the opening date here. I opened this position, looks like about 18 days ago, June 19th. I opened this position with about $6,000, and then I started collecting the fees. Now, every time I collect fees, the app goes out, it harvests that data from the blockchain so it knows everything that's happening with your liquidity position. And more importantly, it does the math. So notice this first time that I collected fees, it was the first time, and it calculated the APR associated with that event. Okay, so based on one day and a few hours, I collected $32.12 on a $6,002 position. That APR turned out to be 166%. And then the average APR, this is like the batting average. So the next day I collected fees. Well, 2 days later, I collected fees again. And that time there must have been some more volume. And my APR for that fee collection was 181%. And notice that my batting average came up a little bit. So I love that I can see, what has the position been yielding lately just based on this distinct event of collecting fees and what they earned over the last day or two in terms of APR. But I also like that it keeps track of the batting average or the average yield over time. And it also keeps track of any time I move the range. So I moved the range on revert. I did what's called a snuggle. So I didn't have to rebalance the position. I just snuggled the range a bit lower to keep on catching that price action. Collected some really juicy fees. Look at that. Lots of volume there. And that event fee, that event APR was 750%, but it's not sustainable. That was my point. That 86% or whatever it was saying on the Uniswap dashboard, it's going to change. It's subject to change. And so what I like to do, I want all the nitty gritty details. I want all the numbers. I want to do all the math, or better yet, I want an app like this that does all the math for me. It's just one less thing that I have to do in my day. By the way, you might be wondering, how much time does it take to manage a liquidity position like this? Well, you just saw within the span of maybe 10 minutes or so, I deposited the position. So that was that. Of course, I did a lot of other stuff and I did a lot of explaining. So I've been going for an hour and 27 minutes. So whatever. If you open a position, it's going to take you some time. But when I come back tomorrow and I collect my fees, it takes less than a minute. I just bring up the Uniswap site. I click on the position. I mean, I could do it right now too. I'm not going to, but I think I already collected fees for this position today. But I just click this button, collect the fees. The fees come out. They go right to my wallet and I'm done. Less than 2 minutes to do this. So unless the price escapes your range and you want to rebalance the position or move that price range, it's really just a minute or two per day to just come and collect the fees. Now, if you want to move the range, then it's maybe 5 to 10 minutes. I mean, it's very easy. And again, the app keeps track of that. And it tells me when I move the range, then I collect some more fees. I move the range again. And actually I believe just this morning, I moved the range yet again, and I deposited some extra capital. I took advantage of the price being a little bit lower than I thought it should be, bought a little bit more, and added some capital to that position. So pretty cool with the fee tracker. You can see my average APR on this. Very volatile token, and much more risky than something like ETH USDC. This is the Venice token. So it's a very new token, extremely volatile, much more risky, but you're also getting compensated for that additional risk to the tune of some pretty nice yield, average of 236.5% yield on this so far. If we get a bounce and it goes back into my range and I start collecting fees again, this will probably go back up. I was started out, somewhere in the neighborhood of like 250% plus or minus kind of throughout this position. So anyway, that's the fee tracker, and I've gone way too long on this stream now. I appreciate everybody tuning in. If you're watching the recorded version of the video, man, if you've watched the recorded version up to this point, that's an hour and a half. I really appreciate you. Make sure to like the video, leave a comment down below, and most importantly, subscribe to the channel and turn on those notifications. I know every YouTuber on earth says that. In my case, it's really important because if you have the notifications turned on, then you get notified when I go live. And every live stream is an opportunity for you to come in, ask your questions. I don't care if I spend the entire stream answering questions. I usually have something like this planned out that I'm going to present and talk about. But if I spent an entire live stream just answering questions, I would be more than happy to do that. So that's your opportunity. You don't have to do this alone. I've been doing this for, gosh, I started in DeFi in summer of 2021. So it's been 5 years. It's been over 5 years. I started in May. So I'd be happy to help you out, give you some guidance, and teach you how to do these different things. It's not trivial. It's not rocket science, but it's not trivial. So if you need some help, sign up to the channel, subscribe to the channel, turn on notifications, and come into the next live stream next Tuesday. All right. That's it for now. Thank you all for tuning in. Hope you have a great week. Bye-bye.